Good afternoon and welcome to this week's macroeconomics analysis session for December the 11th, 2015. DMAC with you this afternoon, and sitting alongside me is Jeff. Welcome to you, Jeff.
Thank you, Dave. Hello, everyone.
Busy week coming up next week, Jeff. A lot of news coming out of the US. Each week we go and have a look at the data that's coming out, and certainly some big circles and big underlined events this week. So let's get through our disclaimer and get into it. The content of today's presentation or any other Elite Traders Club material or Elite Wealth material does not constitute a recommendation, nor does it take into account your investment objectives, financial situation, nor particular needs. Before making an investing decision based on the general advice presented in any of our presentations, please consider whether the advice is appropriate in light of your financial circumstances. Alright, the week in review, Jeff. The key points from this last week, I guess, bit of news out of Australia there in terms of job ads, etc., and employment change, but I'll let you pick the eyes out of the imported data from this week.
Yeah, look, I will focus mostly on Australia, and it was a very good week for economic data in this country, which is something a little bit rare in recent times. Certainly you can see job ads have risen, so employers are starting to hire more, getting more aggressive on that side of things, and you can see that ties in with the next point where business confidence has jumped, so it's been positive for a few months now. And then that obviously at some stage, it almost works. First, businesses get confident. After they get confident, they decide to hire, they advertise jobs, and then within a couple of months, hopefully they've found the right person, and then you see people actually getting hired. So we had fantastically strong employment data this week. The unemployment rate dropped down to 5.8. And it had been from 6, and it had been about 6.2 a couple of months ago. So we are seeing some good signs there locally, and whilst we're seeing a lot of jobs being shed in the mining sector, it's good to see that they're being soaked up elsewhere in the economy. So certainly a good week for Australia.
I think the previous month, there might have been the employment numbers came out, and there was some conjecture as to whether they were real or not, that there might have been a glitch with the statistics.
Yeah, look, the ABS changed the way they calculated these numbers about a year ago, and it delivered a couple of surprising numbers, and the ABS actually came out and said, look, don't pay too much attention to our figures at the moment because we're just tweaking things. But since then, things have settled down, and the numbers have consistently beaten expectations. So if it was a one-off number, I would say, look, it might just be the way they've crunched the numbers, but it's the employment market has been much stronger than anybody expected, and much stronger than the RBA expected. So what was interesting, when the employment data came out, the Aussie dollar shot up more than 1%, and the Aussie stock market fell. And the implications of that is, after the jobs data, everyone's saying, well, that's such a good result, that's such a good, strong sign for the Australian economy, that there's no way now that the RBA is going to think about cutting rates. So, that's good news for the economy. In a sense, it's bad news for traders because the market wants lower rates. But it's one more nail in the coffin for lower rates in Australia. And that sort of employment conditions versus interest rates is the big one of the big issues at play in the US, as it is everywhere. So I'll talk about that in a few minutes when we look to next week. Otherwise, look, it wasn't the biggest week in terms of data. The trade balance numbers look a bit off because the first number's in US dollars, the second one is in local currency. So 54 versus 395 is not a fair fight, but the trade balance was the surplus was lower than expected. In China, CPI roughly in line, and in England they kept rates on hold, which was expected. What was interesting is that they're not expected to change to increase rates for quite some time in England. When inflation starts picking up, they will definitely have to. What I pay attention to is they release every month, not just what the BOE decides with rates, but also the votes. And it has been for the last several months. There's a 9-member panel deciding what to do with interest rates. One person wanted to increase, no one wanted to cut, and 8 people said on hold. So I don't talk about that every month, but before you see the rate rise coming, you'll start to see more of the members shifting from wanting to hold and moving towards the hiking. So once we see that split change, you're getting into the minds of the panel, and you'll get a bit of a warning. So that's just something interesting to look out for.
Coming up as well. Yeah, interesting. All right, well, we might go through and have a bit of a look at the market. So there's our benchmark for the Australian market. And again, you can clearly see that that ceiling in there around about the 5,300 level that since end of August, we really haven't been able to stay above that level for any significant length of time. And more recently, since retracing from that level, coming back up, having a couple of attempts to get through it, and it couldn't. So very, very bearish signs there in our market. It continues to be very, very weak. As you've no doubt experienced and seen, on the telly and the news, the market just seems to be, grinding lower and lower, since around about May of this particular year. If we go through and have a look at the US, interesting to see that, again, previous support levels, once they've been broken, we've gone through this a number of times. Old support levels tend to act as resistance levels into the future, which it did on this massive breakdown that we had through the end of August, beginning of September. Price from that point in time, once we got through that ceiling, it came back down, retested. It moved back up again and came back down. The interesting thing here is that this medium-term peak here is much lower than the previous one. So certainly key points of supply up the top here, getting lower. It's not a particularly good sign for the market at this point. Last night, a pin bar there, just hanging on to these levels at the moment. If we fall through this level and potentially over the course of the next week, we may get some volatility depending on what the Fed does do. Certainly if the Fed does raise interest rates, look, I think it's going to be volatile. I think the market will sort itself out. If the Fed doesn't, then I think we might get some extreme volatility, and who knows what the market will decipher from that. But certainly, some previous levels here around 460 will be interesting. These were resistance levels previously. So if we do happen to fall through here, then that's obviously the next target. If we happen to go through there, then even lower, should we happen to break to the downward side. And you'll see our risk indicator has really started to roll back over. We're firmly in moderate for this time frame. And again, once we get down to sort of, in particular, the 60 levels, anything can happen. So we'll just have to wait and see what happens. Certainly, what happens on the US markets will have a large impact on our on what happens in the Australian markets into the next couple of weeks. So hold on to your hats, I think. Jeff, next week?
Yeah, look, I'm going to kick off with the US because that's the big one. Not just next week, probably the biggest economic piece of data this month. Probably, arguably, the biggest economic development this year. So you can see all there the FOMC, which is the panel of the Fed that decides interest rates, and look, it's much more than likely that they are going to raise rates. At the moment, rates are officially between 0.25%. So it's not like in Australia where we have a specific number. They've got a range between 0.25%, and the consensus is they're going to raise it to 0.25% to 0.5%. Or as I like to think of it as 0.375. I'll just pick a number in the middle. It's easier than thinking about the range. So they are expected to raise by 0.25% effectively. That's not going to surprise the market. That's now being priced in. That's being expected. And as we've discussed in the last few weeks, I think that if they don't raise, that will cause much more problems from the market than if they do.
Yep.
Raising is now becoming the expected and the almost what the market wants to see. So that's not. I think if they do raise, it's not going to be a huge deal. What will be interesting is to see what the Fed says about what comes next.
Yeah.
So, first of all, I don't think they'll give any specific guidance. I think they'll say, we're raising now, and we will be guided by the market and the employment markets before we see what to do next.
Yeah.
Now, I've been talking about this actually all year. The last time the Fed went through a Fed tightening cycle of increasing rates, about 10 years ago, a little bit over 10 years ago, they raised rates 17 meetings in a row over 2 years by more than by 4.25% over a couple of years. And so just every meeting they went, yep, another 0.25%. Fast forward to the next one, another 0.25%. And they have come out they've come out in the last 6 months and said, when we go, this cycle is going to be different. It's not going to be automatic. It's not just going to be every month. It's not going to be every second meeting. The pace is going to be gradual, and it's going to be according to the data. So they're going to keep an eye on things and raise as they see fit. One thing they've also said is that even if the two main things they're looking at is for the unemployment rate to come down and inflation to start ticking up. If those two things are in place, in theory, they should be raising rates. But they have actually made a bit of a backup for themselves and just said, look, even if these things are moving in the right direction, the US and the world may need lower than normal interest rates. So don't expect to see, like last time, interest rates going up by a big stack. So I don't think they'll give away too much. I think they'll come out and they will probably say, we will be guided by economic data for the next lot, and they will probably repeat the fact that rates, even when they are going up, will go up slower and will probably stay lower than is normal. So what does that mean? Look, at the moment, the market is roughly pricing in about another 1% next year. So if you think that we're between 0.25 and 0.5% by next week, we'll be around about 1.5% in the US by the end of next year. And some people think it's going to be around 1. Some the more hawkish think it's going to be around 2. So sort of 1.5%. Maybe the Fed will raise rates every few months, once a quarter, something like that. And their economic projections, and the Fed actually releases their own sort of prediction model.
Yep.
And the market will react, I think, mostly to that prediction model, more so than anything next week.
Well, interesting, because whilst the market's obviously potentially factoring in that the rates are going to go up or be consolidated, call it what you like, at that level, that a number of currencies, as an example, in New Zealand, they dropped their interest rate by, I think it was 0.25%, which normally would see that currency drop in value against the US. After the announcement, the Kiwi dollar actually rose, which is quite counter to what you would typically expect. What do you see the significance of that? What's the market telling us about the US and their level of interest rates? Because if their interest rates are going to go up and everybody else is dropping them, then we should have seen the Kiwi dollar dropping. We've seen unusual strength in the euro. Obviously, Draghi came out the other day and said, well, look, we've got lots of ammunition that we can fire if we need to. We don't need to do any more than what we're doing at this point in time, and the euro rallied really strongly. And you might have expected that little bit of exuberance may have tempered, and we've seen the euro come back down. That hasn't happened. So there must be a feeling or a sense somewhere out in the broader market that maybe there might be a chance that the US doesn't increase rates.
Yeah, look, so that's definitely at play. I mean, I think currency markets are moved by many things. One of the biggest factors is what we call differential interest rates. So obviously the differences between interest rates in different countries. And if one country is raising rates and the other one's cutting, the one that's raising rates will see its currency go up, cutting goes down. And so That's what's at play. Now, the US is really is the only major economy that is raising rates at the moment. So that is good for the US dollar. And obviously, the Europeans have been flooding the market. The euro's been spectacularly weak. But that can only go on for so long. I mean, everyone... It's what we call a crowded trade. I mean, everyone has been playing on the same side of that for a long time. The US dollar has gone up significantly. The US dollar index, which is like the US dollar against the world, if you think of it that way, not the US versus Euro or Aussie, the US versus everything has gone up from, let's say, 70 to 100 in the last 18 months. So it's gone up. The US dollar is strengthened by 50%. Roughly speaking, and so it can't keep on doing that. And the US also won't want the American dollar to go up more and more and more, because it means their exports become more expensive. People stop buying things from America. So I think we've gotten to the stage where everybody has been long the US dollar against the rest of the world, that any sign of weakness of that divergence is going to see it move back the other way. So, like in Australia, when the RBA's been talking and they say something to the effect of rates are on hold, that's it. The Aussie dollar goes up, because there's just, even if they don't say rates are going to go up, the fact that they're not going down, or they're not coming out with some talk and rhetoric saying we're thinking and this is what's possibly going to push the Aussie dollar the rates even lower. The absence of bad news is enough to be good news. So I think that's what's at play. And certainly I think we're probably getting pretty close to the stage where I don't think the US dollar is going to collapse, but I think it's probably had the run. And people have been buying it for a year and a half in anticipation of the US rates going up. Once it starts happening, it's sort of too late to buy in to say now, if the US dollar is raising rates next week, I should buy some US dollars.
Interesting that you mentioned that crowded trade aspect, because obviously there was huge short quantity, if you like, on the euro for a long period of time. It's just been, and that little statement from Draghi shot the euro up like 300 pips, right? So crowded trade, and then obviously people having to short cover and all that sort of stuff. At the moment, if interest rates are going up in the US, and I'm sounding more like a fundamental analyst here, if interest rates are going up in the US, then in terms of bonds, then what happens to the yield on those and bond prices?
Yeah, so as rates go up, and I don't want to get too technical or confusing here, but we'll summarise a bunch of economics in 2 minutes. So as rates start going up, bond prices will fall. And that's because if I had a bond if I bought a bond today, I'll keep it simple, buy a bond from the US government today, and they agree to pay me a certain interest rate. If I buy a bond in a year from now, when the US has higher interest rates, that bond in a year is going to be paying higher interest rates. So it's going to be worth more than the one I bought today. So the value of the one I bought today goes down, because the interest rate I was getting that looked okay now is not as valuable. So the value of the asset that pays this return goes down. Rising interest rates in the US should see bond prices fall.
Correct. So my question to you is, that is probably been expected, priced into bonds over the last 6 months, 12 months.
Yes.
Right?
Can I just jump in for a second?
Sure.
So and you've alluded to this and I have, but I haven't said it specifically. What moves markets is changes in sentiment, not necessarily the actual direction. So, and what I mean by that is that if US interest rates are doing nothing for 2 years, and then in year 3 and 4 they put up interest rates in year 3 and 4. Now we know that higher interest rates should lead to a higher currency. The currency doesn't move in year 3 and 4 because rates are going up. because that's already happening. It moves in anticipation.
Yep.
So if in 3, 4 rates go up in years 3, 4, and then 5, they're still going up, but it may be coming to an end. The currency will fall because yes, rates are still going up, but what's changing is future expectations, change in sentiment. So there's what's actually happening right now, and what is shifting. So like in the euro, you mentioned, everyone had expected more and more and more stimulus, and when the Europeans said here's a tiny bit more stimulus, even though the actions are yes, we are doing something that's equivalent of cutting rates. In fact, they did cut rates, but not as much as people expected. So the reality is they are moving in one direction, but they're not moving anywhere near as much. The markets will move the opposite way. Not what's actually happening, but what's changing.
Yep.
So bring that back to the bonds. The bonds have been pricing in a certain set of increasing rates over time, not just this December, but what's going to happen over the next 2 years.
Yep.
So what does happen over the next 2 years compared to what people are expecting, that will change the bond prices.
Yep.
Not whether rates go up, but whether rates go up faster or slower than people were expecting.
Okay. So at the moment, I mean, if you have a look at Treasuries, TLT as an ETF as an example, has been coming down over a period of time. I'm just wondering whether or not, depending what happens next week, there's obviously directional biases telling us, well, what's the market think of this, that the market expectation, bonds coming down, that interest rates are going to go up, etc. Depending on whether they go up quickly or slowly, we might end up being on a crowded trade which turns out to be wrong, and we might get a big move in TLT as an example.
Yeah, so something that we've discussed is look, it's pretty certain that the Fed's going to raise next week.
Yeah.
To an extent, they've backed themselves into a corner. I'm not even they've pushed it back many times. Right? I think they really don't want to have to raise rates. And then at one stage, Yellen said it's going to happen this year, and everyone thought it was going to be September. And then there's to an extent it's only happening next week because the Fed has to look like they're sticking to their word. They don't want to seem, unreliable.
Yep.
So once they get this one out of the way, they've done what they said they would do, and now they are free to do, to an extent, whatever they want.
Yep.
And there is a good chance that the rate rises will be really slow. I don't think the Fed has a huge appetite to raise rates and to pull the brakes on everything. I think they're doing just the minimum of what they can get away with. And so if rates can be raised from a speed of 0 kilometres an hour to 100 kilometres an hour, and if we assume that the market is expecting 50 k's an hour, I hope this isn't a terrible analogy, but a certain speed in the middle of the road, right? Not ridiculously fast, not ridiculously slow.
Yeah.
The market is expecting rates to be steadily, sort of 50 kilometres an hour. If rates are raised much slower than that, then that TLT will shoot the lights out.
Yep.
And the US dollar will come down significantly. If they raise rates at 100 miles an hour, actually it should be 100 miles an hour because it's in America. 100 miles an hour, then obviously the bond prices will come off. Not just because they're raising rates, but rates are raising faster than expected.
Yeah.
And the US dollar will then kick into another gear and go much higher.
Yeah.
But I think there's very little chance of seeing supercharged rate rises.
Yep.
If I had to pick one direction, it'd definitely be that after next month, future ones are going to be very slow. And I mean, you put forward the hypothesis recently that we might only see next year, one or two more rate rises, that it could be, extremely gradual.
Interesting. It'll be a fascinating week next week for sure. All right, that's it, folks, for this particular week. Have a good weekend. Those of you in the Elite Traders Club, I will see you all on Monday morning. Jeff?
Just an announcement to all. Next week will be our last week of webinars for the year. So we'll have the normal Monday morning session, and I'll have an education session. I'll have my session on Thursday. macro on Friday, etc. And then I think the plan is to resume when the week starting the 11th of January. But we'll send out emails with all the details in there. But for this year, it looks like there'll be one more week of webinars, and then you can get a break from us.
Yeah.
Recharge your batteries as we will over the holidays, and come back raring to go a couple of weeks into January.
Terrific. All right, folks, have a good weekend. We'll catch you on Monday.